Hello, everybody. This is Dylan Moore and Nima Majur of iRead TV. You haven't seen us in a while. Both of us have been moving around a lot. In fact, I'm borrowing a friend's office here because I'm traveling myself. But Nima, I think it's time to address the fact that we're absolutely wrong about everything on inflation and how MMT is just some crazy pseudoscience. Don't you think? It's time to confess.
Yeah.
No comment.
No, it's yeah. It's just
Well, we're past the COVID era. The inflation has continued and the spending hasn't slowed down. So clearly, the spending has led to the inflation, and that's the commentary that we seem to be getting. And let's just break it down. Let's have a conversation on why things are more nuanced than that.
Yeah. Also, some people keep suggesting that hyperinflation has finally happened. Peter Schiff was right. So,
Can we define hyperinflation real quick, just so we can?
yeah,
What is hyperinflation according to economists?
It's something like 30% plus per month of inflation.
You know what we could do? Oh, I deleted all my cookies. I was going to ask AI, because now that we have AI that can answer anything, I could say, according to economists, what is inflation? Let's ask it. I'm using Venice.ai because it's the private, decentralized AI that doesn't keep any of your information, unlike all the rest of them. So, according to economists, what is the definition of hyperinflation? All right, Venice.ai.
I'm asking our Descent bot just to see what it comes up with.
So 50% inflation per month is more or less the definition for hyperinflation. So Peter Schiff was absolutely right. We've seen 50% inflation month over month, right?
No.
So
that has not happened.
We've got a lecture here from Randy Ray, who's a prominent MMTer, that we're going to dabble into. The lecture will be in the show notes. But really taking a dive into what exactly was happening during and after COVID, right? During and after the lockdowns of, yes, we saw this incredible spending from every country on earth, or at least every Western country on earth. And then we saw the prices go up, and the prices have continued to remain high and continue to inch upward. And it's easy to say, well, because of this spending, because of this increase in the money supply, we are obviously having higher prices. But before we even jump into that, I think into the video. I think it's worth just putting some other basic factors on the table, right? Because if we have inflation is basically a loss in your purchasing power, and I want to be clear, if I want to avoid the definition that inflation is just an increase in the money supply, which is a definition that seems to get thrown around a lot. Because if the definition of inflation is an increase in the money supply, and then you turn around and say, well, inflation or increasing the money supply causes inflation, you are technically correct because the definition is equal to itself. That is a utterly non-useful definition. Yes, if you increase the money supply, you have inflated the money supply. We're more concerned about the purchasing power of your money. How much does it cost to buy things? And, has the aggregate price of this or that increased or decreased? That's what we're talking about with inflation, or in the case of decrease, deflation. And there were a couple big things that happened on Earth all at the same time, and the COVID lockdowns were just one of them. During the COVID lockdowns, I got to thank Peter Zahan for this, as much as he's rubbed us the wrong way for other things, but pointing out that because most countries on Earth, and specifically Western countries, have this boomer bubble happening, baby boomer bubble, which is to say the baby boomers were the biggest generation in human history, and they didn't have as many kids as their parents did. We are during, I think it was either the end of 21 or the beginning of 22, at least in America, the number of baby boomers retiring officially became greater than the number of Gen Z entering the workforce. And year after year, we're looking at a situation where it's like 500,000 a year delta, like 500,000 more people retire than enter the workforce. So we are now entering a demographic situation of a labor crunch. That is inflationary, right? That is going to increase prices on everything. Another thing that happened in China is that China had this zero COVID policy forever and ever and ever and kept things locked down for much longer. And China is also experiencing a boomer bubble, worse apparently than any other country on the planet, to the point where apparently Mexican labor is now cheaper than Chinese labor. Because remember, the whole neoliberal um, world trade order was based on, okay, we'll outsource everything to the cheapest place possible, which was usually China, and we'll make the things cheaply over there. Well, China's labor is no longer the cheapest labor available because they are literally running out of people. All right. Another big one to put on the table, and this is one that's typically pointed out, but for whatever reason doesn't get the credit that I think it deserves, is that the COVID lockdowns caused a massive supply chain shock for everything. So, does it stand to reason that prices may go up because, okay, the boat isn't able to show up on time, or the container ship isn't able to show up either in the same speed it was before, or the insurance rates went up, or for, I mean, whatever reason, the uh, supply chain broke down and has had difficulty coming back to life. Then the third big one, which is the Ukraine war, is that started in what, February 2022, if I remember correctly.
Yeah.
Ukraine was like the breadbasket of that area of the world in terms of the food that it was creating, and obviously they're not generating what they were generating before, which has additionally messed up supply chains, and of course has messed up the
Yeah.
supply for against the demand. So point, and there's even more of this that we're going to talk about. But I wanted to put these like big, gaping, obvious pieces on the table to just be like, okay, money supply is not the only variable here.
Yeah. So also with the Ukraine war, what I want to add is you talked about the food supply. Much more importantly, was the oil price
Yes,
spiked up
thank you.
substantially as a result, and that was something that happened in 2022. So I think the last time we talked to Steph from Free Domain Radio about this, about inflation, we discussed, because even I think this was 2021, if I'm not mistaken, inflation had picked up noticeably. We talked about lumber prices and commodity prices like that. Obviously, largely due to supply chain coming to a halt and all kinds of COVID policies that were really stupid. And we had also said back then, as a result of these large deficits and you're sending stimulus checks to everyone, we're probably going to see elevated inflation for the foreseeable future. This was 2021. We're probably going to see inflation. I believe I said on that call, we're going to see higher single digit inflation possibly for the coming months and or years. But then 2022, February 2022, the Ukraine conflict broke out. So that was an added factor that we didn't even know about at that time. And that was the year when inflation spiked all over the world, in particular noticeable in the Western countries that weren't used to high inflation for decades and decades, right? So in the US, I think the year 2022, ironically also, of course, the year when the Fed started raising interest rates, right? So people always say raising interest rates stops inflation. The year the Fed started aggressively raising rates was the year that we had the highest inflation at 7% in the US. And I think in countries like Germany that are starved natural or that don't have much natural resources, it was even higher, went up as high as 9%. largely because of the oil price shock from the Ukraine war. So that just added to the complications from the COVID supply chains and the large deficits not going to any productive labor, but just replacing existing income, um, which people ended up using to buy a lot of electronics and stuff like that.
Yeah. I
Into
went
them.
to Lowe's. I went to Best Buy. Right.
And our services also, online services, became more utilized. Stuff like Zoom, Zoom calls became the norm. This was all maybe to some extent like kind of a psyop to get people, to get the boomers finally dependent on all this technology. But um, so a lot of kind of amazing inflation didn't rise even more. I think actually, in light of all these factors in the U.S., obviously it's a testament to the large and diverse nature of the U.S. economy, always ready to ramp up production, supply the goods that are needed, even when we're going through some kind of inflationary period. So yeah, definitely, Ukraine and oil price shock played a big role, and maybe also the Federal Reserve raising interest rates to at record pace injected a bunch of money. At this point, it's injecting about $1 trillion a year into the U.S.
And then
private
explain
sector.
that again, because I think that needs to be hammered home. Is why, because the orthodox view is that raising interest rates slows, either removes or slows down the creation of money into the system. And you're just saying, wait a minute, high interest rates is injecting money into the system.
Right.
Break
I
that
mean,
down again for the millionth time.
there's no evidence for this supposed causation between interest rates and money supply. In fact, when you run through the numbers, and you look at the budgets, you can see that raising interest rates injects more money into the private sector from the public sector. So if interest rates are raised, you have basically the Fed declares a new risk-free rate at which banks can obtain reserves overnight, and it also effectively becomes the rate at which banks, or slightly below that rate, banks lend to other banks overnight if they're short on reserves. So that raises the loan rate that the banks charge to would-be borrowers by approximately that delta that the interest rate is going to. So when we went up from about 0% to 4%, right? Actually, even 5%, that means that basically, by and large, all private sector loans, credit cards, mortgages, etc., went up by about 5% or so. But on the flip side, savings account earnings also go up by about that same amount, which I still hear people talking about. With your savings account only makes you 0.5% or whatever. I don't know what savings accounts they're using or where they're getting scammed, but the
Yeah,
average
there's 4% savings account. I mean, maybe not four now that they dropped a little bit, but you can find 3% savings accounts all over the place.
yes, 4 to 5 even. So if you,
Yeah.
but even that's why I always recommend just put it in treasury market, mutual, uh, a
Even
treasury,
recommends, but this is not actually financial advice.
not financial advice.
Nima for himself.
Even though this is the safest possible
And,
asset,
and I happen to listen to Nima, but I don't sue him because he doesn't.
not
Whatever.
financial advice. That's just what I do.
Yeah.
So you can put your money in a treasury money market account, and it'll earn about 3.9 to 4% right now. If you put it in a treasury bills directly, auto roll on Fidelity, probably even get about 4.25 to 4.5%, 4.25%, I want to say. But you don't have the liquidity of the money market fund, obviously. But so my point just being that the earnings on the savings accounts match the increased earnings on savings accounts in the private sector matches pretty much to a dollar the delta in interest payments that the private sector has to make now. I know and a lot of people aren't savers, I guess, so it doesn't feel like that to them. But in aggregate, for every loan, there's a deposit. So for every interest payments that are increased, the corresponding savings accounts that the money ends up in, unless some of it isn't obviously in checking accounts, okay, but that's only for transactional stuff. Majority of it sits in savings accounts, treasury, money market, mutual. They will earn about the same amount of interest as the loan rate has increased. So that is a wash to the private sector. There's an increase in interest payments, but there's an increase in savings interest earnings as well. That's a wash. However, all the money, all the treasury bills and bonds interest are net injections into the private sector on top of what I was just explaining. So you have the two savings and lending rates, deltas matching one another. On top of that, you have treasury bond and treasury bill interest earned by the private sector. That is all free and clear extra earnings to the private sector. And like I said earlier, I think the U.S. government pays something like $800 billion to $1 trillion per year in interest to the private sector.
And to be clear, sorry to interrupt you, but that's an injection from nowhere. Right? There's this idea, and we're going to be going over these orthodox views. There's this idea that we got to go tax the money to generate it or borrow it so we could pay this stuff now. That's totally false. That's not what's happening at the Federal Reserve. When the bond matures or they have to pay out the rate, they just type a number into a computer, bloop, and the number appears. So when Nima says it's a net injection, okay, so there's $1 trillion of bonds that mature every year.
Way
That
more, way
or,
more.
I'm sorry, the net injection. Excuse me.
Yeah, interest payments per year.
As the interest payments have increased, it's not like that money has to come from somewhere. It's just typed into the computer. So when the interest rate goes up, it's literally injecting money in from nowhere. But as Nima likes to point out, only with people who already have money.
But also, it doesn't.
Yeah.
It's not earned by people who do work, right? It's
Yeah.
earned for doing nothing. It's a basic income for the rich. So that is on its face, I would argue, inflationary. Now, some people may say, well, but these people don't spend the money, they just keep accumulating. But some of it may trickle out. Like I said, it's not a hard and fast rule, right? One way or the other. I'm just saying that the numbers wise, there's a stronger case to be made that high interest rates are inflationary. Also, you can look at countries like Turkey and Argentina until not too long ago.
5 minutes ago. Yeah.
Yeah, they had very high interest rates and very high inflation. Professor Werner has pointed out that the only empirical conclusion we can arrive at is that that the central banks of the world adjust their interest rate based on the current inflation level. So they follow the inflation rather
As opposed to causing it.
as opposed to causing it,
Yeah.
which I am guessing, kind of the semi tinfoil hat in me is guessing that maybe that's just what they want. Maybe they just want to preserve the money owner's wealth by paying them some sort of corresponding interest rate that makes up for the inflation that they've measured.
I don't even think you need a tinfoil hat. I would say that's an obvious pressure, right? Whether or not they're succumbing to the pressure, or that's the main pressure or the secondary pressure, whatever. I would say that that's definitely a pressure of, hey, I'm billionaire whoever, and if you increase the rates by 3%, I get however much money more a year for nothing, right? So I would.
Absolutely.
I don't think that's even semi tinfoil. Maybe it's tinfoil to say that that's the actual reason, but I would say it's absolutely a pressure.
No, I don't know, because these people at the top, they kind of don't really know what they're doing. It's usually the people who are behind the buttons and faceless and nameless who know what's going on. But the political decision makers, as we have heard from many people like Warren Mosler and others, and Richard Werner, they don't really know how this works, or they just don't want to bother with trying to explain it to people who have been propagandized with a bunch of neoclassical bullshit,
Right.
and are just going to, not going to vote for them.
I want to address one more thing about whether the interest rates create more money or not through the private banking system, because I have heard this argument as well, which is, and it sounds like a reasonable argument, is that, well, if you increase the interest rates, you're making money more expensive to go out and get a loan, right? Whether you're buying a house, buying a car, you're financing a business, whatever. So the amount of loans, which we know are creating money out of nothing, decrease because the money is more expensive.
Well, do they though is the
Yeah,
question.
wait, that's what I'm saying. It's a reasonable argument, but when you look at the evidence, they
Yeah.
don't.
Right.
Right? So Mike Norman, who's as far as we know, the only MMTer who's giving trade advice online, he just, I don't, every day, every week, however often he does it, there's Federal Reserve reports that tell you here's how many loans were created today, and he can look at the year before and go, okay, well it's up, it's down, it's left, it's right from the year before, and we're paying attention to Mike Norman, and almost every time it's like loans are up, loans are up, loans are up. Yeah, even through the whole COVID interest rate increase fiasco, people are taking more loans even though the interest rates go up. So I mean, I don't know exactly why the reason is that might be the case, but
Well,
the reason
because
kind of doesn't matter because we can just look at the evidence.
yeah,
Yeah.
it's plausible that the reason is just that the economy, the corporate sector has been very profitable because of all the deficit injections. But these deficits end up in the form of corporate profits at the end of the day. And when corporations have good profits, then people want to lend to them. And it's easier for them to obtain loans when they have when their asset base, that their profit generation is backing that up.
Well,
Um,
I mean, not wanting to dox myself here, but I mean, I'm done a business acquisition before. I'm looking into another one right now, and for the first one, I did get a variable rate SBA loan, and I didn't get it like at the bottom of COVID. I got it like when the interest rates were like halfway up, and then they went up the other half after I bought the place, and it was annoying. I mean, my added another $1,500 a month of interest or whatever to the payment I had, but in terms, it didn't wreck the business, right? It was, I mean, like you said, all the prices went up from at the same time. So I mean, obviously, I'd rather have a low interest rate than a high one. I don't want to pay any interest, but at the same time, it got the deal done, and we're making money. And on the next acquisition, I mean, it's not like, oh, we can't, interest rates are too high, we can't do it. It's just, okay, well, how does the math work out, and how do we adjust the offer based on the math?
let's go through some of the comments here.
Oh, are you looking at the Stefan
No, no,
video?
no, no. Our video right
Oh,
now
we got some comments.
we have Jesus and Russ is also commenting.
Oh,
So
I'm not. They're not showing up for me. So you read them.
yeah, so first is Jesus. Jesus, the inflation came from corporations raising prices just because they could, combined with
That is another factor. Yes.
for sure,
Yeah.
combined with people overpaying for homes and cars, which usually are people's biggest expenses. Yes, so corporations set the prices of goods and services, no question. And when they can, they will raise the prices. So that's what they did. Also, there's a paper that Randy Ray wrote about inflation. It's an amazing paper where he goes through the orthodox approach to inflation and then the post-Keynesian MMT approach. And I keep wanting to delve into that paper one of these days. But it's very esoteric and very lengthy. So I'm trying to figure out which.
Well, maybe we'll hit it when we go through his PowerPoint
Yeah,
here.
yeah. I think
Video.
he
There's
maybe
some
had
good, there's some
something.
juicy stuff in this PowerPoint.
But
Yeah.
he talks a lot about why do we have prices, right? So this is kind of important in inflation discussion, is what is even the point of price? Why do we have prices? And it goes into how the neoclassical and the Austrian approach, the barter approach, it has it kind of fundamentally wrong. And so if you have the fundamentally wrong approach about prices, then you're going to have some problems in the rest of your theory. But he talks about how prices are a tool for economic units to accumulate surpluses. Those can be businesses, those can be workers, those can be farmers, laborers, bankers, and there's this constant tug of war in the economy between different interest groups who want to raise the level of prices that they demand for their goods and services. There's corporations who want to always raise their prices. There's
Yeah,
workers
we
who
want to make
always
as much money as we can. Yeah, and sorry to interrupt your line of thought. A price raise, if it doesn't change your number of customers, goes straight to the bottom line because you didn't add any expenses to go along with that price raise. You just raise prices, and then your gross income goes up, but your net income goes up by whatever that price raise is. Sorry, I'm just trying to describe how attractive it is for a corporation to raise prices, keeping everything else the same.
Absolutely. I mean, the corporations are constantly surveying the market, right? Have their feelers out. Can we hike it up a little bit? Can we get up? Let's test it out a little bit. Okay, no complaints. Okay, test it. I mean, I know that too from clients that I work with, right? To raise it a little bit, see if people complain. Yeah, of course they complain, but they still buy. Okay, let's keep pushing as far as we can. And then there's labor too, and labor unions and all that. So
For wages, yeah, and
yeah,
then I
for
mean,
wages.
if your wages go up, that's the biggest expense, and then you have to raise prices.
Right.
Yep.
So then there's this constant tug of war between labor, capital, of farmers. They want to raise the food prices, right? Bankers want to raise their loan interest, the risk premium that they earn on the loan interest. So there's this constant tug of war between different interest groups, and prices are a mechanism to maximize inflows and actually then in turn maximize profits, which enables you to get more loans. So this is actually something that neoclassical and Austrian theory doesn't think about a lot, but post-Keynesians and MMTers think about a lot. Actually, this is the constant cycle of a business: is try to raise your prices, sell your products, obviously create value also and all that, but try to raise your prices, raise your profit margins, and the profit margin enables you to get more loans so you can expand your business, so you can get more market power, right? So
Right.
this is the reality of the corporate world. Look at the mega corporations today, who occupy, like, I don't know, the Magnificent Seven. They make up a significant portion of the S&P 500 at this point. These are companies like Apple, Google, um,
Amazon.
Amazon, maybe, but definitely Apple, Google, Nvidia, obviously, because everyone's using AI now, right? So Nvidia's up there. Microsoft. These are products that we all use, we all interact with. So it kind of makes sense that these companies are so huge, and they're also very profitable. These are not the dot-com days, right? So there's no
Mhm.
dot-com bubble forming with these companies. These are profit generation machines, and so. Um, but what do they do with the profit? Like, they get more investors to invest in their business. They sell more stock. They get more corporate loans. They issue more bonds. Look at MicroStrategy. MicroStrategy buys Bitcoins, and then Bitcoin price goes up. And with the Bitcoin price having gone up, they have more collateral to borrow against. So they issue more stocks and corporate debt to buy more Bitcoin, and so on and so forth. Obviously, a big disaster is going to happen one day here, but
You mean if there's a dip in the Bitcoin price?
yes,
Yeah.
or not. Maybe just pick the exact perfect moment to do it, and it's all going to be fine. But it is a gamble to some extent. But then there's other companies, the ones I mentioned earlier. They're doing it based on profitability, so there's more fundamentals backing what they're doing. But yeah, definitely this constant tug of war makes it so that price levels just always kind of go up, right? It's like a normal situation for a capitalist economy with these special interest groups always trying to push a price up. There's nobody who ever goes, hey, why don't we um, ask for lower wages, so that then we can have deflation, so that we can buy cheaper jeans later on.
Right. Right. Yeah. That's the.
Because
I'm
this
actually trying to think of an example of an interest group that would want prices lower. I mean that's in control. Obviously, the consumer wants to lower prices, other than choosing what they're going to buy, they don't have control over those
but the
prices.
consumer wants higher wages too, right? So
Yes.
Um, so the only possible compromise appears to be that, okay, prices have to keep going up continuously to some extent, and every one of these groups wants to grab a slice of that, right? Grab a
Well,
slice
I
of
can
that.
think of one deflationary pressure. which is to say, if a new technology comes out that says, "Hey, it cost $10 to make this before, now we can make it at $1, and we can undercut all the competition from before." That's the
Yeah,
one thing I could think of
for sure.
that'll deflate prices. Yeah.
AI automation.
Hmm.
Um, Although it doesn't seem to have happened yet, right? Because it creates new opportunities as well. There was an article recently somewhere about how IBM replaced their support workforce of, I think, something like 1,500 people, and their support satisfaction score went up from something like -30 to +70. I guess it's kind of a more positive versus negative. The
Right.
net positive is negative. So their score went up after they replaced all their support people with AI support. I mean, I'm just just trying to
That's
express.
hilarious because I'm infuriated when I talk to an AI
Yeah,
because I'm like, I know you can't answer my question. Just give me the representative.
but there are they're getting better, right? So there are
Okay.
some that can do that. And then once we get into AI agents, it's all going to get even crazier.
Hmm.
Who can actually perform activities and actions, but amazing, right? -30 to +70 or something like that, from replacing your entire support workforce with AI. But they had to rehire 1,500 people to
To
support
manage
the
the
AI
AI.
system. Yeah. So that's an aspect that's important, I think. So yeah, we're always gonna have this net inflationary pressure in the economy, I think. And then there's other aspects that I read a little while ago also. For example, there are professions, right? Because profitability and worker productivity goes up over time the more the economy becomes capitalized, right? The more
Hmm.
automation, the more computers, the more machinery, we get more output per labor input. But there are some professions where this will never be the case, right? The violinist will never become more efficient
Yeah,
from
he'll never play two violins at the same time.
right. The barber will never cut the five people's hairs. What maybe there's going to be robots one day doing this, but
Right.
for the time being, there are certain professions where okay, so we're going to keep them. We're going to keep their earnings at 1880 levels, while everyone else made more. Then they can't exist, right? These
Right.
professions couldn't exist then, and then we couldn't get a haircut. So that's another kind of interesting aspect that I read, that maybe it's just a corollary of all of this, but definitely this tug of war of prices constantly going up, and people constantly trying to maximize inflows, minimize outflows, creates this tug of war that it creates the baseline for inflation, and it uses the proper purpose of a price mechanism, of what the actual price mechanism is, to explain all of this. Because the neoclassical model thinks of the price mechanism as an auction
That's
vector,
happening all the time with everything. Right.
permanent auction, right? So it's this an imaginary system, because when you go to Walmart and you buy a stepping stool or this, you don't have an auctioneer standing there. Oh, can you 500, 600? Not how this works. Right? There are so the auction price mechanism does exist in an auction, but in the corporate world, the price mechanism is a little different. Prices are more top down administered, and they are administered before the business even starts producing goods. Because in order to get a loan, the business needs to have an idea of what the price for its product and service is going to be, and pitch that to the bank or the shareholders where they're getting the money from, right? So prices are incredibly important single variable that can make or break things for a business. You can't
Hmm.
sell at a certain price; they may have to shut the whole thing down, and not in the neoclassical Keynesian sense. Oh, the jeans become cheaper now. It's all
Yeah. Yeah. Right. Because I mean, as someone with employees, like, okay, let's say the price of the good of the service goes down to the point where, okay, we either need to lay people off or we need to start paying them less. And so, hey, employee A, you've been working great. You're making $20 an hour, but guess what? Good news. Things have deflated. So your purchasing power is stronger. So we're going to go from $20 an hour to $15 an hour. Does that sound good to you? Like, they don't care.
right.
Like,
Yeah,
Are you crazy?
it's
No.
this can only happen in a severe recession or a
Right.
depression. Otherwise, in normal conditions, this will never happen. This is why, in normal conditions, we have a bias towards net aggregate price increases in a capitalist economy, which is an economy with prices essentially.
One thing I want to mention in terms of corporations dictating prices, like Jesus pointed out, is this idea of price gouging. Because I don't know what the neoclassical view is, but I know in the Austrian view, they say, well, there's actually no such thing as price gouging because of this constant auction system. When you have an emergency, let's say there's a hurricane and, for a week everything's shut down, and you say, okay, well, gas is supposed to be $4 a gallon, but you got it here as $20 a gallon, you're price gouging because people need this. And the Austrians come back and say, no, 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 what that gas station is doing is he's valuing a limited resource, because if he keeps it at $4 a gallon, it's just going to be bought up and nobody gets any gas, versus if he puts it at 20, the resource will only be allocated to where that it, to the point where that it's really really in need. Right now, I don't want to throw out that
Oh,
reasoning, because again, I believe there is a pressure that of that that's true, but at the same time, you can't point at that and say therefore there's nobody greedy who's trying to take advantage of people in an emergency situation. Right? It's
yeah.
both. Yeah.
Let me just quote a little piece from this paper, and I'm going to throw it up
Yeah.
because it goes into that. Um, this paper I recommend it to everyone really because it's like a really heterodox, interesting approach. It's called Money and Inflation. It's a working paper, so I don't really know if it's ever officially been published or whatever, by L. Randall Ray. Um, you can get it for free. We put a link in the
We'll
show.
put it in the link. Yeah. We'll put it
But
in the
I mean, there's a lot of stuff before this I'm getting into. But I just want to mention this one thing here. Uh, the post-Keynesian approach to pricing. Um, So, because there's this idea that, in the classical theory anyway, there's this idea of market clearing, right? The supply and demand curves match, and that's how the price emerges. And the perfect free market price clears the market. Demand meets supply. Everything's beautiful, wonderful. How this works in the world of theoretical,
Right.
mathematical economics, right? Um, so then he goes into, okay, he explains a lot beforehand before I get into this about why this is not, there's no evidence for this. This is a fictitious model. There's no market clearing. Prices can be perfectly all participants can be perfectly happy with the particular price and it not clear the market is also an case. So I'm just going to read from this part here. The post-Keynesian theory of inflation. Recall that in the orthodox approach, an invisible hand process establishes equilibrium relative prices that simultaneously clear all markets. Each individual relative price reflects relative scarcity. Nominal prices, in turn, are established in terms of one of the commodities, a numeraire, and, at least in the long run, are determined at some scalar times the relative price vector.
Oh, God. Sorry to interrupt. We might need to translate what he's talking about here. He's using some pretty
Each individual,
hoity-toity
right?
economic terms. Yeah, keep going.
Yeah. Don't try too hard to understand this, right? So I
Yeah,
just want, he gets into what the post can. He just says this is the going theory. Holding velocity constant, the aggregate price level is simply determined by the quantity of the money commodity. Post Keynesians reject every aspect of this formulation. Okay, so here we get into the
yeah,
idea that money supply determines price levels.
yeah.
Post
And I want to break that down just because it makes sure everyone understands velocity. That's how often something is trading, or how
Mhm.
often people are buying and selling. So what he's saying is, if we don't change the rate at which people buy and sell stuff, the classical and Austrian understanding is that prices are therefore dictated by the supply of money. If you
Yes.
increase the supply of money, you keep everything else the same. Prices go up. If you decrease it, no, excuse me. No, that's right. You increase it, prices go up. You decrease it, prices go down. That's what he's saying is the neoclassical and Austrian argument
Yeah.
that he's
Post
about to critique. Yeah.
post Keynesians, which basically MMTers are kind of like post Keynesians. They are a step further from post Keynesianism, but post Keynesians reject every aspect of this formulation. First, what matters is nominal price, not real or relative price, which is simply a residual calculated by dividing nominal price by some index number. Second, most prices are administered to accomplish a number of firm specific goals, and no priority is given to market clearing over other goals. And third, the quantity of money is endogenously determined so that the causation of the quantity equation is essentially reversed with price times quantity determining the quantity of money required. So
Okay, we got to break that down. I got lost.
yeah,
What's
the point
endogenous?
is
Yeah.
that money supply is not announced by some entity. The Fed doesn't say the money supply should be this or that. The money supply emerges out of given existing market conditions when businesses borrow from banks. That increases the money supply, for example, right?
Mm-hmm.
So there's no such thing as increasing the money supply without a whole bunch of other stuff being woven into that event occurring, which is a business that is profitable, that has a price, that has an idea about what price it can charge for its product, and goes to a bank in order to be able to get a loan for this entire project. And then ends up
Right.
following through, succeeding, validating that investment, then expanding, investing more. So this is his point is that there's no such thing as an exogenous. Exogenous would be somebody snaps their fingers and the money supply is so and so. Endogenous means
Oh, I see what you mean.
it emerges out of market
It's
conditions.
connected to other processes that are happening at the same time. Right. So, well,
Absolutely.
to your point, like, let's just kind of make the example more tangible. Me and Nima are going to start a headphone production business, right? And so we need to get a loan from a bank, and we borrow $1 million from a bank. We start a business. We hire people. So we're taking unused resources theoretically,
Well,
which is from the labor pool,
first of
and
all,
we're creating a product,
sorry.
right?
First of all, you have to explain to the bank before you even get the loan. You have to explain to them what is this product, what does it look like, what am I going to charge for it, right?
Yeah.
I just want to
And
make
then
it clear how important it is.
how do you know people are going to buy it and you're going to be able to pay this loan back?
Mhm.
Right. So the point being is when that $1 million is created and we turn around and we're successful, we've increased the money supply by $1 million, but we've also increased the things in the economy that you could buy.
Yep.
Right. So the goods and services that have increased with the money increase. That's what's meant by endogenous, as opposed to, hey, the government printed more money. It just fell out of the sky. Although I guess going back to our earlier conversation, increasing interest rates is
Interest rate
somewhat.
is interest rates is an
Yeah.
example of an exogenous variable. Yeah. So the risk-free interest rate is exogenously set by the Federal Reserve Bank. So that's an example of an exogenous variable. Money supply is an endogenous variable because it is not decreed and declared by some entity from the outside of the system. It emerges as a attribute of the existing system, with the whole thing preceding that event, which entrepreneur going to a bank with a product project, then getting the loan, increasing the money supply as a result of a bunch of stuff that has already occurred. So that
Right.
the causation of
And I think this is also. Go ahead.
well, I was gonna keep reading.
Okay. Let me add this point then. I think this is a good time to point out what Richard Werner points out is that there's really two things that you can generate money via loans for: businesses and assets. If you generate money for businesses that are creating new goods and services, you're typically not going to see inflation because the goods and services are increasing with the amount of money increasing. Versus if you just throw it at assets, and I think real estate is one of the easiest things to think about, where if the whole banking sector says, okay, really push to have more real estate loans, but you're not significantly increasing the number of places to live. Now you've got more money bouncing around the same number of assets, the same number of things to buy, right? So you could see inflationary pressure if that money generated is thrown at assets that are already existing versus thrown at businesses that are going to create new goods and services.
Yeah. And
Yeah.
the quantity of money is endogenously determined so that the causation of the quantity equation is essentially reversed, with price times quantity determining the quantity of money required. You understand now the
Yeah.
price, huh?
Yes. I
Yeah,
was nodding my head. I get it.
the price is determined before the bank even gets the loan. And so price times quantity determining the quantity of money required, the amount of money that I have to borrow, or the bank will loan to me. The post-Keynesian
Hmm.
approach to pricing, especially the approach to the pricing decisions made at the individual level of the firm, is dealt with in another chapter. However, it is useful to briefly examine Hyman Minsky's views on price formation in order to provide the background to the post-Keynesian approach to inflation or determination of prices at the macro level. In Minsky's approach, all financial commitments are in nominal terms, and all income flows
Nima,
are.
I'm sorry. What's nominal mean in this sense?
It's, you look at the actual amount of money and not some adjusted amount.
Like today there was some inflation.
Yes,
So yesterday it was real dollars, but so yesterday it cost $1. Today it's $1.04, but in real dollars it was actually one.
yeah, and also because the thing is, in the neoclassical approach, there is no money actually. Interestingly, in that sense, because prices are just a reflection of the relative um, relationship of the value of the goods to one another.
Hmm.
So he's kind of making the point that, in the neoclassical approach, it almost tries to eliminate the relevance of these processes that we're describing here: borrowing money from a bank, getting it to your bank account, having liquidity preference. Uh, MMT looks at money more as a real thing that has a real impact. Neoclassics looks at it as an afterthought, or kind of a little
It's a
annoying.
ratio,
Yeah,
basically.
it's an annoying little tool that facilitates other things that are paramount, more important. In Minsky's approach, all financial commitments are nominal terms and all income flows are nominal terms. It matters whether an economic unit's nominal inflow is greater than its nominal outflow. Hence, money cannot be neutral in this sort of world. This view is similar to the monetary theory of production briefly examined above. However, Minsky's analysis focuses in greater detail upon modern financial relations. In the real world, nominal prices are administered in large part to gain control over nominal inflows, while relative prices are just a residual that is mainly non discretionary. So,
Break that
again,
down.
prices are set by a corporation from the top down in order to achieve company specific goals. They're not an expression of some individual's relative preference of one good over another. And they're in that sense also, what follows from that is that they're not market clearing. Prices are just a residual that is mainly non-discretionary. Relative prices, um, so in the real world, nominal prices are administered, and they're administered top down to achieve
Hmm.
profit goals. Minsky argued that prices in a monetary production economy perform five main functions. Prices, one, ensure a surplus is generated. Two, ensure that at least some of the surplus goes to owners of capital. Three, ensure the market or demand price of capital assets is consistent with current production costs, or supply price. So this is um, this
Ensure that
is
the market or demand price of capital
so
assets is consistent
yeah.
with
So
it.
the demand price of a capital asset uh, is the max that I'm willing to pay for a machine, and the
Because I
supply.
know how much money I can make with it based on prices.
Yes, and the
Right.
supply price is how much the manufacturer of the machine is willing to sell it for at a minimum.
Mm-hmm.
So as long as the supply price is below the demand price, a transaction occurs. Is the point,
Got it.
right? And this can also be extrapolated to stocks and stocks, actually, in a sense, because then company um, is willing to sell stocks at a certain price. Investors are willing to buy it at a certain price. As long as demand and supply prices are consistent, transaction occurs. And
Mm-hmm.
again, yeah, these prices are based on profit expectations, which are based on revenue expectations, which are based on prices. Number four, ensure obligations on business debts can be fulfilled. And number five, ensure resources are directed towards the investment sector, that is, to allow accumulation of capital. Um, okay.
Yeah.
I don't know if
I
you
was
want to
gonna say,
examine
I
these,
think we better stop before we start reading the whole paper.
but yeah, you don't have to understand all of it at once now. Just to give you a sense of what kind of other uh, theories of inflation are out there. And
Well, and then I mean, this is even before the theory of inflation. This is just like the theory on money itself, like you mentioned. Here, let me get rid of this screen. Um,
oh, okay. So
yeah.
then let's at least talk about the next paragraph, because he does talk a little bit more.
Oh, okay. Let me pull it back up.
So here, post-Keynesians adopt an aggregate markup theory of pricing, in which price is determined at the macro level as a markup over labor cost.
Right, as opposed to an auction system
Yes,
where supply meets demand because there's an auctioneer standing at every Walmart
exactly.
corner. Yeah,
The price of consumption goods must be high enough above wages in that sector so that some of the consumption goods will be left for workers in other sectors.
that makes
This
sense.
Yeah, so it means basically the workers producing our headphones, they must not be allowed to be able to afford all those headphones. The headphone
Right.
price has to be a little higher so that they can't buy up all those headphones, so that some other headphones are available for people who work in the investment sector, which is
Or
goods
the
that are
food
not,
sector or the whatever sector. Yeah,
investment or government, but people who work but do not output consumer goods into the market,
I
basically.
see. Yeah,
This allows some workers to be put in the investment sector and government and trade sectors to produce the surplus goods and services that workers cannot buy. At the micro level, each capitalist must be able to obtain a markup over labor costs, ability to do which depends in part on market power. However, at the macro level, there won't be any profits to distribute unless there's spending in excess of the wage bill in the consumption sector.
well, break that down.
So there would be no corporate profits if. So the easiest example would be a hand-to-mouth economy, where
Well, and then maybe before we say that, when he says wage bill, does that mean the labor cost or does that mean
yeah,
labor legislation?
labor cost.
Oh, okay, okay, okay. Got it. Yeah,
So because um, if we think of a hand-to-mouth economy, everyone digs up turnips and eats them. There's no surplus at any point in this economy. There's no aggregate surplus. There's no possibility of corporate profits.
I
But
see. So there has to be enough spending in the system to be more than what we're paying the laborers.
yes, so there has
Okay,
to be investment spending, in other words, and government deficits and export surpluses. There has to be these three. The sum of these three has to be positive, in order for the possibility of corporate profits to even exist. And when I say I mean aggregate corporate profits. I mean it's possible in the hand to mouth that one person accumulates surplus, but that will be the other's loss.
right.
The only way to have aggregate corporate profits is to have investment and government, is to have a sum, a positive sum of investment spending plus government plus deficit spending plus export surpluses. They don't all have to be positive, but the sum of them has to be positive. This gets into the Kalecki equation, which we have discussed also on this show. The aggregate macro price level determines the aggregate potential surplus to be divided up among all the firms in society. The capitals then compete at the micro level for profit flows. What generates this aggregate surplus to be realized by firms at the macro level? As the Kalecki equation shows, the aggregate amount of profits is identically equal to the sum of investment plus consumption out of profits plus the government's deficit and the trade surplus, less saving out of wages. In the simplest model, no government deficit, balanced trade, and no saving out of wages, profits equal investment plus capitalist consumption. If the price is set high enough that workers cannot buy all the output, capitalists can get the rest so long as they spend. So capitalist consumption is if you earn dividends and you spend those dividends on consumer goods. That also adds to corporate profits, ironically.
Mm-hmm.
Right? So it's kind of like at the aggregate, as an individual buyer, you're losing out on this profit because now you spent it on consumption. But in the aggregate, corporate profits go up because there's more revenue for corporations, more money going to corporations.
Which again is pointing to the fact that the price is administered.
Yes. At the individual level, market share is important to maintain a sufficient markup, the source of profits at the micro level. Normally, a firm cannot even obtain finance unless it has market power. Each firm tries to set a price high enough to cover all expected costs and to provide a margin of safety.
That's huge. I want to stop right there because that's the discussion that I have with my business is we're looking at, okay, if we're making this decision or we're making that decision, let's say we make a bad decision and we got to eat the cost. How long are we able to eat that cost for before it ruins us?
Yeah.
And if we're facing, if the decision that we're looking at, we're going, we can't survive if this goes south, we don't make that decision.
Yeah.
Right? So I just want to emphasize that this is totally true.
The bigger the margin of safety, the more willing banks are to lend. To put it very simply, the goal of every firm is to get market power so that it will have control over its markup so that it can get loans. This is the corporate process in reality. Corporations want to have control over prices so they can demand higher prices, so they can make more profits, so they can get more loans, so they can expand more.
Get bigger market share. Yeah.
Thus, the ability to set and maintain price is critical at the micro level to obtain loans and to service them. Indeed, Schumpeter argued that credit is the means by which capitalists ensure they can divert the allocation of resources to the investment sector.
I want to add to that too. Something that banks are very concerned about is, okay, you have this price today. Are you going to have that price tomorrow? Because if we're not sure that you're going to have that price tomorrow, we can't lend on this. We need to see stability. So that's another force that says, okay, there's a force by the capitalist to say, I have to ensure that if the price is this today, that I'm able to safely project that for 3 years or whatever the bank wants to see. Otherwise, the bank's going to be like, we don't have confidence in this.
Yeah, market power. Market power and the ability to set price is critical in determining who gets credit, but the amount of surplus available at the aggregate level depends on the aggregate markup. This in turn depends on capitalist spending, mainly on investment, although it is supplemented by government deficit spending and trade surpluses in the expanded model. In other words, market power and even technological efficiency only affect the distribution of profits, but not the aggregate amount. It is the aggregate spending on investment that generates the profits that validate the accumulated capital. In this sort of world, with ability to affect price and with expected price rather than actual price as the critical parameter, there's no reason to believe that equilibrium exists, and even less to believe that it would be stable.
Right. This is my main. I got two main criticisms of the current economic models, both Austrian and neoclassical. The first is a barter theory of money, and the second is the fact that equilibrium exists.
Exactly.
It's there's no evidence of this equilibrium.
It's a nice. In other words, the prices of the real world are nominal rather than real and are administered to achieve a variety of goals, not simply to clear markets. This is
And then also, sorry to interrupt again, Nima. Just I keep talking to try to bring us out of the academic language here, so we don't put everybody to sleep, and so I understand. But when he's talking about nominal rather than real, the feeling I get when economists are talking about the real price is that, yeah, I know this is what the price tag says, but it should say this,
Right.
right? It shouldn't be that. It should actually be this, and we're going to go off what it should be as opposed to what it is,
Right.
right? Yeah.
Uh, it eliminates. So an interesting aspect, I guess, of neoclassical models, they eliminate uncertainty. And in the real world, there's uncertainty. There's an expected price, and then there's a realized price at the end also, right?
Mm-hmm.
Um, and which means actual inflows and outflows. This is not to suggest that firms can achieve desired prices as discussed. The aggregate markup that can be achieved depends on aggregate spending, investment, government deficit, trade surplus. And if that level is too low, capitalists on average will not achieve desired markups. In other words, actual prices realized will be below those that were desired. So
What?
if the,
What?
for
Go ahead.
example,
I want to say something before you keep reading, but go ahead.
for example, um, government deficits have a huge impact on this. Government deficits largely end up in the form of corporate profits. So this is not some theoretical blabbering here. This is literally what happened in 2020, 2021. These mega corporations I was talking about earlier, Apple, etc., they banked major profits because of the stimmy checks that were sent out to people. And it's not a theory. It's even the Apple CEO, Tim Cook himself, said this. Um, he said that thanks to these programs, we're making more profits than ever. Yeah. So
Yeah. Well, and then to the point that you said about the government deficits. So scroll up a little bit. I want to see that last sentence from the previous paragraph. So this is not. This is not to suggest that firms can achieve desired prices as discussed. The aggregate markup could be achieved. The aggregate markup that can be achieved depends on the aggregate spending, which includes the government deficit. And if that level is too low, capitalists on average will not achieve the desired markups. Well, I think it's important to point out is if the capitalists cannot achieve the desired markups, if that's drastic enough, they can put the capitalist out of business,
yeah,
right? Because one of the arguments that we make from an MMT standpoint here is always if you have a government surplus, it almost inevitably leads to a recession. And that's the explanation right there is if you cut off the flow of funds where this process that we've been talking about where prices are administered and okay, we got to get money from the bank and we got to make sure that we can show that the prices are going to be moving, be stable moving forward at a level that achieves we could pay the bank back, we could pay the workers, we could pay ourselves, we could have a surplus in order to increase market share. If that gets curtailed, the whole thing just collapses.
yeah,
The prices don't go down. Like you said, it's not like, oh, the jeans just went from $20 to $10 because, the equilibrium just leveled itself out and things are half price. No, just the whole thing collapses and there aren't any jeans,
yeah.
right?
As discussed, according to orthodox theory, inflation shouldn't matter much. While it might temporarily fool people in the short run, in the long run, it cannot have any effect. Even orthodox economists have empirically estimated that moderate rates of inflation, up to 40% per year, have no measurable effects on GDP growth. These theoretical and empirical results, however, contrast markedly with orthodox policy prescriptions, which call for vigilant central bank watch over inflation rates. Indeed, at the beginning of the new millennium, orthodox consensus appears to be that central banks should only be concerned with inflation and that they should keep inflation below some very low rate, such as 2% per annum. What is most remarkable is that orthodox economists are willing to impose very high, quote unquote, short run costs uh, in terms of high unemployment and low GDP growth in order to attain low inflation, the benefits of which are at best thought to be very small.
Right. Well, this goes back to okay, screw what's actually happening in reality. Our number needs to be right.
Yeah, number needs to be perfect. So I feel
We need
good.
to have the right number so as many people who get unemployed, as many businesses get destroyed. That's not that important. What's important is our number looks good.
Yeah, it's almost like a cross discipline mental illness because it exists in so many fields where we saw this during the COVID lockdowns. We have to achieve this number of positive COVID tests and all that stuff. Almost exists universally. Global warming, same idea, right? Temperature needs to be grow at 1.5%, and that's the perfect number for some reason.
Right.
In contrast, post-Keynesians believe that nominal prices do matter. Ability to administer prices is essential, particularly given long-lived and expensive capital equipment. As Ingham notes, money prices are the result of complex power struggles, both between capital and labor and among capitalists. When labor is strong, it can push up wages. In order for individual firms to maintain markups from which profits are derived, they must raise prices in compensation. This could be called cost push inflation and would be more likely to result from decentralized wage bargaining in the presence of strong labor unions, with each individual union trying to obtain larger than average wage increases for members and possibly generating a wage price spiral. On the other hand, markup or profits inflation results when firms are able to raise the markup over wage costs. At the individual level, the markup is largely the result of oligopolistic pricing processes.
Wait,
However, as
I'm sorry, oligopolistic.
yeah, it's a few people controlling a
Okay,
market,
okay, got
not
it. Yep.
one, or a few entities, not one. As discussed, the aggregate markup is determined by certain kinds of spending. Thus, the aggregate markup over wage costs will be higher if investment spending, the government's deficit, and the trade surplus or capitalist consumption is higher. All things equal, a society with rising investment or export or government deficits as percentage of GDP will face higher rates of inflation as the aggregate markup will have to rise to ensure that domestic workers can purchase only a falling share of output. This is the crucial sentence here, I think. So
Yeah.
this
Break it down.
encapsulates the MMT theory of inflation, probably better than anything else, or at least Randall Wray's view of inflation, is that these are the factors causing demand or side inflation or cost push inflation, incomes inflation, also called. We saw this with the COVID deficits and other things. But basically, if the investment spending, if the sum of investment spending plus export surpluses plus investment spending um, as a share of GDP rises, then that can cause inflation. Okay. Now, he also discusses another form of inflation here. Inflation caused by rising wages or rising markups is often called incomes inflation to indicate that it results from a struggle to increase the income of either labor or capital, right? So this is this tug-off process that,
Hmm.
as the available share in the pie rises, these entities compete for higher prices. But also, in addition to incomes inflation, overall price increases can be induced by rising spot prices. The
Neva,
best
real quick,
example,
keep talking. I gotta use the bathroom. Keep going.
okay. In addition to incomes inflation, overall price increases can be induced by rising spot prices. The best example would be an increase. The best example would be I lost my would be an increase in energy prices, such as those experienced during the mid and late 1970s and repeated on a lesser scale in 2000. And this paper, by the way, was written before 2022. So February 2022 was another period where commodity prices, namely oil prices, rose significantly, and oil prices just filter through everything. And cost, he says here, rising energy prices of course affect the cost of production of almost all goods and even of most services. Firms will attempt to pass these along in the form of higher prices of intermediate and final goods. If energy prices are increased only once, they could cause only a one-time price shock, resulting in a higher aggregate price level. By itself, this would not be defined as inflation, which implies continuing price increases. However, the price shock could set off a struggle by workers to maintain nominal income shares and real inflation-adjusted wages, which could generate a wage price spiral if firms attempt to maintain markups. So here he discusses then, the oil shock in and of itself, if that's processed and dealt with appropriately, then that would cause a one-time price increase, which is not necessarily defined as inflation, but it doesn't matter. I mean, in the colloquial common discussion, it will be looked at as inflation, and so most likely then these kinds of spirals ensue where the workers want to have more too. But then keep in mind that the businesses did not raise their prices because they sought to obtain a larger markup, a larger net profit, but only because they had to in order to maintain their existing markup, right? So it would be very unhealthy for such a wage price spiral to ensue if the spot price of a commodity that is set by a monopolist goes up, or by a somewhat monopolistic or oligopolistic process rises, then that is the cause of the problem, and that is the cause that should be addressed. So, in modern terminology, I guess it would be if expensive energy prices are the cause of rising prices in 2022 in Germany, in the US, and other countries, then that is the issue that needs to be addressed by, for example, some of the trends that are occurring right now, such as nuclear proliferation, small modular reactors, all that kind of stuff. There's a huge race going on to reduce energy prices significantly, and that could have a bouncing effect on any kind of price inflation caused by future oil shocks.
Nimi got a little muffled all of a sudden. Just
Uh,
I don't know if you're farther away from the microphone or what the deal was, but you're still coming through. It's just a little bit muffled. So yes, I think we've detailed quite well that
so,
there's a
sorry,
different.
that's
I would argue. Go ahead.
because there's one more important. I keep finding more important paragraphs after this, so I just want to get into this one here real quick. Um, Note that inflation is much more benign than deflation. I do need to share it.
Oh, you're just gonna read it?
I can share it. That's
Yeah,
okay.
I gotta share it. It's pulled up.
Okay. Note that
Yeah.
inflation is much more benign than deflation in a monetary production economy. The main impact of inflation is on distribution of income. It tends to redistribute shares toward economically more powerful groups, from workers to capitalists, from non unionized workers to unionized, from unskilled to skilled workers, from fixed income pensioners to those of working age, and from competitive sectors to oligopolistic sectors. On the other hand, inflation tends to reduce debt burdens and reduce inflation adjusted returns to creditors, which tends to favor lower income households as well as industry over finance. Thus, on balance, the effects of inflation may well be favorable towards encouraging investment and economic growth. In contrast, deflation not only has significant redistribution effects opposite to those listed above, but it also increases debt burden. This favors rentiers over debtors, but only if the debtors do not default. Significant deflation will generate bankruptcies, in which case even creditors are no better off. Indeed, Fisher's debt deflation theory, adopted by Minsky, attributes the severity of the Great Depression to price inflation that
Deflation.
generated, price deflation that generated a snowball of bankruptcies and destroyed financial wealth. Thus, post Keynesians generally recognize that deflation is a much more serious problem than inflation.
Yeah, and I mean it's there's a intuitive idea that I like it when prices go down because I can
So
get
I'm going to
more
use
of
the
my
restroom
money.
now, okay?
Okay, Nima's turn. So yeah, there's this intuitive idea that hey, if prices go down, that's better for me because I can spend more with my money, which is true. But as Nima just pointed out in what we were reading, that a deflationary pressure within the economy, it not only makes it a heavier burden for creditors, excuse me, for debtors, which is to say, okay, I borrowed $100,000 when I could work for $20 an hour, but now everything deflated and I only earn $10 an hour. Now the burden of that $100,000 debt has just doubled. So in a lot of cases, now extrapolate that to business. Let's say you've got a business that they've create some good or they do some service and they're in debt in order to make the business go. They got a loan, and suddenly everything deflates. And even though all the prices deflate, all the wages deflate, they still owe the same amount of money, right? They still owe the same nominal in the language that we've been using. They still owe the same nominal payment. And if it gets to the point where they can't make the payment, the business collapses and the creditor now has a bad loan on their books. And if they get enough of those, the creditor collapses. So the whole thing just gets destroyed. And I think the Great Depression is a perfect example of this. The whole thing just gets destroyed. And it's not as simple as, well, hey, prices went down and now we could all spend more with our money. It's complicated, man. So with the inflation, I mean, nobody likes having their purchasing power robbed, clearly. But as I mean, when Nima gets back, we'll get into this more. It's obviously not as painful as deflation, and the conversation can start once we understand about this. Prices are administered from the top down uh, process, and that money comes from government spending and the banking system, is to say, okay, what is the appropriate way to utilize that money creation process? I already mentioned it earlier with the what Richard Werner has mentioned, and I damn near everything I've seen him talk about is we can create money to chase after assets that already exist, or we can create money for businesses that will create new goods and services. Or versus government deficit spending, Nima mentioned this. Okay, we can have give stimmy checks to everybody so they can go buy new flat screen TVs and do some minor home improvements by going to Lowe's and Home Depot, which are the only stores that are allowed to remain open because the small competitors aren't. Um, that's not a significant improvement on the economy. Or even from the Build Back Better, I was listening to this some number of months ago where someone was showing John Stewart how stupid parts of the Build Back Better bill were, where something like $45 billion was spent by the federal government to expand broadband, and they connected zero customers.
Well, and wasn't there like several billions spent on electric car batteries, and then they built like 2 stations or something?
Yeah, where it's we could say, oh, spending good, spending bad, but if we want to have a real conversation that looks at all the variables on the table, we could say, well, we want the spending to be accompanied by something productive and useful, and spending $45 billion in order to connect zero people, or $1 billion to create 2 charging ports or whatever it was, clearly that does not meet that requirement. Right? So in the neoclassical, and especially the Austrian approach, is typically get government out of the way, let the private sector do whatever it wants. Get government out of the way, let the private sector do whatever it wants, which, I mean, I agree with. However, you have to understand that money itself is a public sector thing. The banking system is a public sector thing. Yes, they have market and private oriented uh, pressures where they want to make money, but what they are allowed to do and what they're allowed to make money on is entirely regulation by the government. And it's not like, oh, hey, if we take away all that regulation, the banks can do it more effectively. No, if you take away all the regulation, there wouldn't be any banks. Because the banks have the ability to create money via the regulation, right? I mean, am I saying this, Nima, in a way that makes sense, or am I making it more confusing?
Um,
You don't know. Okay. Point I'm trying to get at is the instead of worrying about the national debt, this conversation actually started with me and Nima a couple days ago, pointing out the fact that people like Elon Musk are freaked out about the number on the wall. look, the number's going up, it's bad. The number, the national debt. Instead of freaking out about the number, let's look at the nuance of everything going on here and say, how do we make intelligent decisions about, okay, yes, the number's increasing. As we just read, that might not be as bad as you think it is. The number's
Yeah,
increasing.
the
What's that?
national net savings, the private
Yeah.
sector's net savings. If you look at it that way, it doesn't sound so bad.
Yes. Do we have more comments?
Yeah. So
I don't see them. I don't know why they're not popping up for me.
we have BS jobs are also inflationary. Just because you're working a job doesn't mean you're being productive. That's from Jesus also. Yes, of course. That's what we
Like
just
the
talked
whole
about.
accounting sector, like me and Nima were talking about yesterday.
Example, going after immigrants that are productive and hiring people to deport them is destroying productivity slash supply chain.
Yeah, but I would argue economics is not the only thing to worry about in
Yeah.
society.
Plus, also, what about going after immigrants who are
Rapists and
rapists
murderers
and
and
murderers?
gang members and stuff. Yeah.
Okay, Russell Jacobson. You're assuming, hi Russ, by the way, you're assuming people have savings or investment. In today's economy, I would wager not many do, me being one of them with only small savings. Yes, no, that's what I was addressing this point is that um, to the individual who doesn't have a lot of savings, this may not ring true, but in aggregate, it is true that for each loan, there is by definition a savings or a checking or savings account. Because when you take a loan, an account is created,
The
and
money's
that
created.
money
Yeah.
is created. That money ends up somewhere, and it largely ends up in checking accounts and treasury bills and earning interest while the borrower pays interest. I see any interest rate increase as always inflationary for the average Jane and Joe. That's possible. Like I said, mathematically, it does make more sense that interest rate increase is inflationary because it injects more money on the net into the economy, and thus,
And the evidence shows that it does not slow down uh, money creation via the banking system.
yeah. Okay, so next. Jesus, have you noticed when interest rates go down, people treat housing like an auction? You might like lower interest, but that's because you understand money. The masses don't they need those high interest? Um, I didn't know. I don't notice
Yeah,
it.
I'm not sure I understand what he's getting at. I mean, if the interest rates go down on houses, there is room for the price to go up because I mean, technically the price doesn't change. I'll break this one down. If you got a house, I'm going to say it's $100,000 as if a house actually exists at that price anymore. I don't know, maybe it does in the Midwest or something, but just for an easy number, you got $100,000 house. However, depending on the interest rate, the amount of interest that you pay is significant. However, you don't see that when you like make your offer on the house, right? You're still offering $100,000, even though on a 30-year loan, if you have a 5.3% interest rate on a 30-year loan, you will pay double the price tag in interest, right? So if you have a $100,000 house at 5.3%, if presuming you don't make early payments and pay the thing off earlier or whatever, you just make the payments over the life of the loan, you have a $200,000 house because you have $100,000 in principal and $100,000 in interest. Now, what most people, when they buy a house, they're not actually looking at the price of the house. They're looking at the payment and they say, can I afford the payment? So if you went from 5.3% to zero overnight, yes, the house would double in price, but the payment would remain the same. That's why it would double in price, is that the purchaser is going, well, I can handle this payment. Well, as the interest rate goes down, the in quotes price goes up,
It,
but in terms of the money coming out of their pocket, it doesn't change.
so yeah, no, lower interest rates. I agree that lower interest rates definitely increase housing prices, increase stock price, increase asset prices in general, because of the expected payment, or the payments as Dylan just outlined, and
The
the
flow from this because the safe, sorry to interrupt you, Nima, but the safe asset, which is a treasury bill, if I can make 5% on a treasury bill that's guaranteed, why would I invest in a stock that would, may make 4%? And it's
yes,
risky, right?
exactly.
So as the interest rate goes down, you go, okay, well, I've got more money that's not making any return anymore. I'm going to throw it at the stock market, and vice
Absolutely.
versa. Yeah.
Or the housing market. So absolutely, this is something that happens with income generating assets. They compete with one another. If the risk free option is very lucrative, then the competing assets, just stocks, bonds, obviously housing as well, are going to be most likely priced a little lower. I just also want to point out, this has nothing to do with inflation, right? When we talk about inflation, we're not talking about stock prices. We're not talking about house prices even per se. We're talking about aggregate prices of all the goods that people commonly buy. It includes things like rent, gasoline, food staples, apparel, all these kinds of things. Um, so Jesus is saying that people would behave more rationally if interest rates are a little higher for home purchase. I mean, that's the job of the bank, right? To lend at a rate that compensates for the risk of making the loan. That's not part of that's not at all the job of the Federal Reserve when they declare risk-free interest rate. But yeah, of course, you need
Well, it's
interest.
also the job of the government to create a regulation that says, look, you can't just have a stated income. You- like
Right.
you gotta make the guy applying for the loan prove that he has the income that he has. You can't just wildly make stuff up, right? Regulation is a big part of that.
Yeah. So, so,
And
so,
I also want to say, nothing you're going to do is going to make people act rationally.
right. So, yeah. I think what does make people act irrationally is this constant up and down of the interest rate, because everyone's constantly chasing the market's reaction to this exogenous interest rate policy, by the way, which is set by one price setter, the Federal Reserve Bank, and which does not serve any specific purpose, really. They have a theory that it fights inflation. As we know, it doesn't. But what it does do is create a lot of uncertainty. People constantly looking at, oh my God, they're going to cut the rates in June, July, September, and then stock prices go up and down. People,
Yeah, or maybe I can't buy businesses because we got this offer on the table to buy this business, and now I can't
it,
because the
it's
numbers have changed. Yeah,
it's manufacturing uncertainty. Why would you manufacture uncertainty when you could just not do that?
yeah.
Don't do that thing that generates uncertainty. That would probably make people behave more rationally. They would focus more on real world things and not so much on arbitrary decisions such as the interest rate policy. Okay, Russ again.
Well, hold on. I want to add to that. Let me say the example that I just gave about the houses and the interest rates backwards, because I think this will make it make more sense. Is that again, when people are buying houses, the major concern is, can I afford the payment? As long as I can afford the payment, I'll pay the house off over time, right? So as long as I can afford the payment, well, if interest rates are zero and the house is $200,000, okay, the house is worth $200,000, but if you arbitrarily start manipulating the rate and the rate goes up, well, that means, okay, if I buy the house at $200,000, I can't afford it anymore because the payment just went up depending on how much the rate went up. So increasing the rates is going to push down the price of the price tag, but it's not going to change the amount of the payment. So by increasing the rates, kind of what you're doing is like the same amount of money is going to transact, but instead of putting it into the pocket of the seller, you just it's going to the pocket of the bank, right? And I would argue that, yeah, okay, either have them at zero or close to zero and just let the prices be what they are. And instead of Nemo said, this uncertainty of, are they going up? Are they going down? Are they,
Well, yeah,
based on
yeah.
some arbitrary decision of some dudes in a, Greek column building.
Right. No, I mean,
Yeah.
just to be clear, you're not saying the mortgage rate should be zero, but the risk-free rate should be
Yes.
zero, and the banks can decide whatever the markup.
The bank can decide from there, right? But then I mean, you'd probably end up with 2 or 3% rates
Yeah.
where the bank can make its profit or whatever, and then like you said, it could just stay there. And then we know the prices of houses are what they are based on factors that actually make sense versus someone just arbitrarily turning a dial back and
Yeah.
forth at the Federal Reserve.
And also, I think it's possible that housing supply has been so lagging for that reason because of this uncertainty, constantly rates changing over the past several decades. Like in the 70s, with the lower population, we used to build about 2 million houses per year, 2 million new homes per year. We need to reach that level and then some in order for home price to become affordable for the average American again. I mean, right now with the population, it probably needs to be somewhere more like 3 million. And we're like, I think the recent numbers are suggesting we constructed something like 1.3 million homes um, year on year, which is ridiculous. It's not enough. So so ironically, it could be that if the Fed declared we make the risk-free rate zero, banks can make their mortgages at 2 to 3%. A lot more home builders would actually be willing to buy more, to build more homes,
Because
to
there's
take
no
that risk,
uncertainty.
right? Because now we know we're going to pay these rates, and the more homes means more rental properties, by the way, as well. So rents would come down for people, So that's and home
Or
prices
at
too,
least
as well. For
stabilize.
landlords.
They would at least stabilize, right?
Yeah.
Because again, if when a home is built, they look at, okay, what's the rent right now, and it's like you said, it's administered, and we said, okay, well, we want to see this return on the other end, so the value of this home, of what it's going to, what we know we could sell it for, meaning we know how much profit we'll get when we build it and sell it. And for the person who buys it for a rental, saying, okay, if I buy it at this price, I know I can rent it for this. That's all part of the equation. But at least it could stabilize. And I mean, it might be to the ultimate detriment of the home builder and the rentier that they would start dropping because
Well,
there's enough places to live.
if you have a competitive home building market, then I don't think it would be a big deal. We just have a much more vigorous, more competitive environment. They build more homes, so even if the rents come down, there can be more properties generating more revenue in aggregate, so that even if they charge lower rents, they're now making more money. Same as the jeans, somebody
Yeah.
sells more jeans for a little bit less. Anyway, had a chat with, so this is from Russ, had a chat with Dylan the other day on the topic of taxes, which are also always inflationary. Here in Washington State, we just had the largest tax increase in state history, and the state has
On
a
fuel. Yeah.
huge
Sorry,
deficit.
go ahead.
Yeah, so taxes can be definitely be inflationary, especially corporate taxes because they're just a pass through. Um, Definitely, I don't know that Washington State has a huge deficit because technically the U.S. states are not allowed to. They are allowed to accidentally generate deficits, but they're not allowed to have a deficit budgeted. So yeah,
Yeah,
maybe
yeah.
that.
I know what he's talking about. Is that the new governor that came in inherited the problem that based on spending and revenue, there was a $15 billion difference or 50 billion. I don't remember how many billion. And there was
Okay.
a scramble within the legislature and the governor's office to say,
Yeah.
okay, where are we either going to cut stuff or raise taxes in order to close that delta? And the winner in the conversation was raise taxes everywhere, including I think gas taxes went up like 40 cents a gallon, like
Jesus.
huge amount of tax increase, which goes back to what we were saying before, is that fuel is one of the most inflationary things that you can have if the price goes up, and then yeah, just to add a 10% tax or whatever it is on the fuel.
That's crazy.
Okay, yeah.
Um, Jesus is asking Russell, do you think both federal and state taxes are inflationary? Um, Jesus, again, the way
I
it
would,
makes sense in my head is taxing productivity and spending for unproductive reasons create inflation. Spending for productive reasons, taxing unproductive activities, slow inflation. I mean,
I would say
so
those are pressures inside the complicated system.
yeah, I think federal taxes, in my opinion, would actually tend to. They have deflationary pressures as well because they
It's
reduce.
actually pulling the money out of the
Yeah,
system.
it's
Right.
destroying money from the system. At the same time, if it's a corporate tax, the corporation passes that on in terms of price increases. So now you have a weird situation where the corporation has to charge higher prices, the same time, money has been pulled out of the system. So maybe it'll show up in as a deflationary effect in other ways. There's no hard and fast rule on this, in my opinion, on whether taxes. I think aggregate taxes, such as federal taxes, if it's a significant tax hike, it's significant money destruction, it can have deflationary effects. But it can also, on the other hand, have inflationary effects. I don't really know. Like we said,
Well, I think it goes to maybe inflation and deflation is not the most important thing to be talking about here.
right, right. It can,
Right?
so, because like we said earlier, there are other factors. So the deficit, export surpluses, investment spending. These have much bigger impact on inflation. Now, of course, taxes reduce the deficit, so in that sense, it could have a deflationary effect. But you may not even notice it because there's these other factors that are paramount. We have a new commenter, L. Wellington. What are your thoughts on a potential tariff and potential dividend checks? I'm all for it. I'm all for it too. I mean,
Sure.
any money distributed to the private sector is
I
not
think it's a
in the private.
a dorky roundabout way to make it happen, but if that's what it takes to make it happen, I'll take it.
Yeah, I mean, at the end of the day, yeah, the more money to the private sector, the better, I think. Ideally, I'm only saying this because they're already taxing us so much, so they can give us some back. Definitely, the tariffs are problematic because they are a tax on the domestic private sector in an underhanded way. So if that would be a solution to that problem, is to just give the domestic private sector the money back that you just taxed away from them for trade policy goals, and maybe it has the effect of increasing domestic investment, which would be a net benefit if all of this comes together, right? So I agree.
And I think it's worth pointing this out on tariffs is this idea that we're going to use tariffs in order to fill the coffers is
Yeah.
dumb. It's dumb because we don't need the money, like we've talked about before. The United States creates its own currency. It doesn't tax in order to spend. It doesn't need that money. Now, that said, I believe there are other reasons where tariffs may be a viable policy tool. For example, I would say punishing countries is one. My favorite was what happened with Colombia. Remember that when Trump first
Yeah.
took office? So he had some illegal immigrants, mostly gang members,
Oh
that got
yeah.
caught. He was going to send back to Colombia, and Colombia goes, "Well, we're not going to take them." And Trump was like, "Oh, really? How about you got 25% tariffs now, and if you don't take them, you get 50% tariffs by tomorrow?" And then Colombia just magically took took
Yeah.
the immigrants back. So for that, I agree. And I think it's also to look at it in terms of, okay, is there an industry that we really need to protect locally because it's a national security issue? Steel, oil, whatever, right? Where, oh yeah, we could get cheaper steel if we just outsource everything to China. That is true, but you want to be in a position where China produces all your steel.
Yeah, like one analogy that I came up with in my head that I always like to point out is, so because people talk about, well, why would you want to restrict trade between two neighboring houses? Let's say you have two farmhouses and I'm selling corn, I'm buying corn,
Tomatoes, and you're selling corn or whatever.
tomatoes, whatever, from my neighbor, and I'm giving him money and he's accumulating a monetary surplus and he's not buying anything back from me. Well, if I choose to buy this corn, all these tomatoes, and give him the money, then what's the problem? Well, if he uses the money that I gave him to buy a bazooka and blow up my house, then what's, how's
Right.
that any good for me? So
Right.
there's political,
There's more things in economy,
yeah.
right? Yeah, it's important to point that out in this economic discussion.
Absolutely. And that gets lost a lot because in the modern world, we created this impression everything is economics, right? And no, it's not. Carol Quigley has pretty, and maybe other political theorists too, pretty brilliantly divided the different social spheres that cannot be substituted for one another. You
Right.
cannot substitute politics for economics. They can complement each other, but you always have uh, military or weaponry, self-defense issues. You have,
You can't substitute military for intellectual.
so let's say I'm a
Yeah.
billionaire. Let's say I'm a billionaire and I have zero weaponry in my house, and a burglar breaks in and stabs me to death. What does my billions help me in that moment? If I had had weaponry, military, I would have been able to defend myself. But all the money in the world did not defend me against that burglar in that scenario. If he made it through, let's say I have no, let's say he made it
You
through
got
the
your point. I think
security.
that was a good point, which
Yeah.
is there's more systems. There's a range of systems, and you can't just ignore one.
Yeah, there's military, politics, economics, social, religious, and scientific, basically. Um, that is true. Deflation is nasty because it leads to mass unemployment. The dollars we need are much harder to acquire. Yes, e.g., 1929, 2008, Japan and China currently. Interesting. I didn't even think that China is going through deflation right now. Japan has for a while. I don't think they are in one right now. Actually, it's kind of the opposite. They've started having inflation after a long time again. China maybe because of the
Yeah, but I
demographic.
mean, it's like this, Nima. The
Yeah, I guess
inflation we're
Dylan
having.
can speak
Yeah.
better to that. Yeah.
Just a point on Japan. I moved there recently. I'm not there right now. I'm traveling around, but I moved to Japan recently, and I am thankful I do not need to work there because you do not make a lot of money working in Japan, and you slave your ass away.
That's what
It's
I heard
it's
too.
not a good economic situation there right now.
I went there for vacation last year and just started reading a little bit more about it. And it seems like your social life is kind of crap in Japan because you barely have one, and you work
And you're not making any money.
right, and you expected to work like 60 hours a week.
And
for a
get paid for
living.
40 because you don't get paid for the overtime. Yeah.
Yeah. So there's
No, thank you.
maybe cultural issue too. L. Wellington agrees with Dylan. I view tariffs as a geopolitical power play. Think beyond economics and more towards hegemony. Yes, exactly. I mean, so I think we already talked for like 2 hours. So I don't
Yeah.
know.
So we didn't even hit the video. We did
Yeah.
the paper instead. Yeah.
We can do that next time as a follow up to this episode, I guess.
Yep. Cool. Well, let's call it at that then, unless there's another one last comment that's coming through. Again, I can't see them.
Nothing yet. Nope.
Okay. Well, cool. Well, thanks, you guys. This will be published later. This has been Dylan Moore and Nima Majur, there's a D in there, of Irida TV. Check us out at irida.tv. We're on X, we're on YouTube, we're on Telegram, we're on BitChute, we're on Rumble, we're on Odyssey.
Check out
And,
also check out dissentwatch.com.
Watch.com.
The web's
For
most good news.
news aggregator. And hopefully we're going to be having a conversation with Stefan Molyneux here coming up. It was supposed to be today, but schedules didn't work out. But that'll be a fun... I don't know if it'll be a debate, but we'll call it one. That'll be a fun second round debate on MMT with Stefan Molyneux. So wait for that, and thanks for watching. We'll see you next time.